Edlin. I'm the President and CEO of the Calgary Chamber of Commerce, and it's wonderful to have you all here as part of a conversation with Tiff Macklem, the Governor of the Bank of Canada. And I think, to have more than 400 people here to come and listen to economic updates and interest rate policy, that's pretty impressive. I think we all want to hear what the Governor is going to be talking about, especially so soon after the interest rate decision that was released yesterday. Governor, we're very pleased that you're here to share your economic progress report as well. And the last time the Bank of Canada Governor was here was 2007. It was Mark Carney. And so it's been a while, so thank you, welcome, and we look forward to the conversation. Before we get into today's remarks and the program, I would like to take a moment to share a land acknowledgement in the spirit of reconciliation. In a few weeks, we recognize National Day for Truth and Reconciliation, a time to honor survivors and remember the history of residential schools. It is a time to recognize and reflect on the history and legacy of residential schools. And it's important to acknowledge the traditional territories of the peoples of Treaty 7, which includes the Blackfoot Confederacy, comprised of the Siksika, Piikani, and Kainai First Nations, the Tsuut'ina First Nation, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Goodstoney First Nations. The City of Calgary is also home to the Métis Nation of Alberta Region 3. And I'd like to recognize and acknowledge that it is our shared responsibility to honor and care of the land, for the lands we are seated on today. We have a few notable guests with us today, and I'm thrilled to welcome the Honourable Lois Mitchell, who served as the 18th Lieutenant Governor of Alberta until August 2020, and David Duckworth, our City Manager with the City of Calgary. I'd also like to recognize our Board Chair and CEO of SureCall, Desiree Mobineau, who's here today as well, and apologize for anyone else who I've missed. We have a full house today. I'd now like to thank our sponsors for today's event. Without your support, nothing happens. So thank you very much to the Alberta Mortgage Brokers Association, BLG, Synovus, Maurer Investment Management, and RGO. Conversations like today are important. Collaboration between policymakers and industry is key to positioning Canada for success. And today is an opportunity to do just that, to bring together Calgary's business community and government and policymakers to discuss the road ahead. And as we look forward, we see that Canada's economy needs to innovate, to attract and retain new talent, to grow our province and our country. Governor, I'm thrilled to welcome you here today to hear your economic outlook for the year ahead and to discuss some of the issues top of mind for business, including interest rates and rising costs, the labour shortage, the importance of a diversified economy, and how to increase Canada's per capita productivity. Now, I want to note that we will welcome questions from our audience members, so you can text to the number on your table card. The Governor knows that I will be checking my phone periodically to make sure that we ask the questions from the floor. And I invite everyone to join the conversation online by connecting us on X, formerly known as Twitter, at Calgary Chamber. Without further delay, it's my pleasure to officially introduce you to Tiff Macklem, Governor of the Bank of Canada. Tiff first joined the Bank of Canada in 1984 after finishing his undergrad at Queen's and held various senior positions, including Chief of Research and Advisor to the Governor, Deputy Governor, and Senior Deputy Governor. During the global financial crisis, Mr. Macklem was Associate Deputy Minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. He also served as the Dean of the Rotman School of Business at the University of Toronto from 2014 to 2020, when he was appointed as Governor of the Bank of Canada for a 7-year term. Governor Macklem, welcome. The floor is yours.
Well, thank you very much, Deborah. It is a great pleasure to be here. The last speech I gave in Calgary had to be delivered remotely. It is so much better to be here in person. And I want to thank the Chamber, and I want to thank our Calgary office, our Bank of Canada Calgary office, for organizing such an impressive event. And I am very much looking forward to meeting and speaking with as many of you as possible. Monetary policy is working to bring inflation down, and we are encouraged by the progress so far. CPI inflation was 3.3% in July, roughly in line with what we expected in our July monetary policy report. Our 2% target is now in sight, but we're not there yet, and we are concerned progress has slowed. Monetary policy still has work to do to restore price stability for Canadians, and we are committed to staying the course. La politique monétaire fait baisser l'inflation et on est encouragé par les progrès faits jusqu'à maintenant. L'inflation mesurée par l'IPC était de 3,3% en juillet. C'est à peu près la prévision du dernier rapport. Notre cible de 2% est proche, mais elle n'est pas encore atteinte. Et nos progrès sont plus lents. Il reste du travail à faire pour restaurer la stabilité des prix pour les Canadiennes et les Canadiens. On va garder la cape. In my time with you today, I'm going to begin by discussing our recent monetary policy decisions. And then I want to dig into the inflation data and give you a sense of what we're seeing and what we're looking for on the path to price stability. I also want to outline the progress we've seen rebalancing demand and supply in the economy. How these evolve will be critical to our policy decisions going forward. Finally, I want to answer a question we're getting more frequently from Canadians. Why are we so focused on the 2% inflation target? Isn't 3% close enough? Short answer is no, and I'll explain why we're committed to getting inflation all the way back to the 2% target. At both our June and July monetary policy decisions, we increased our policy rate, bringing it to 5%. These were difficult decisions, but they reflected the accumulated evidence that excess demand in the economy and underlying inflationary pressures were both proving more persistent. And it was our judgment that more restrictive monetary policy was needed to restore price stability for Canadians. The data since mid-July are providing clearer evidence that higher interest rates are moderating spending and rebalancing demand and supply in the economy. However, we remain concerned that inflationary pressures are persisting and larger than normal price increases remain broad-based across many of the goods and services Canadians buy regularly. Just as it took longer to see clearer evidence that higher interest rates were moderating demand in the economy, it may now be taking longer for this to translate into lower inflationary pressures. We know it takes time for interest rates to work their way through the economy and relieve price pressures. The other possibility, of course, is that monetary policy is not yet restrictive enough to restore price stability. And unfortunately, the longer we wait, the harder it is likely to be to reduce inflation. In trying to balance the risks of under and over tightening, Governing Council decided yesterday to keep our policy rate at 5% and agreed there may be a need to raise the policy rate further if inflationary pressures persist. Going forward, we will be looking for evidence that price pressures are easing. Each month, inflation data is buffeted by many factors, some temporary, some more durable. Given that monetary policy works with a lag, we need to use a broader set of indicators to assess where inflation is going. So let me dig into the data and unpack what we're seeing and what we're looking for. We've been saying for some time that inflation would be close to 3% this summer. It fell to 2.8% in June before moving up to 3.3% in July. So we're about where we expected to be. The biggest contribution to the slowing in inflation since the peak last year has been from energy, which accounts for 2/3 of the slowdown. Price increases in consumer durables like furniture and appliances have also slowed as supply disruption eased and hiring borrowing costs reduced demand. This is welcome progress. But we know that many prices, Those for food, shelter, and many services are not cooling in the same way. And recently, global oil prices have risen again, pushing up gasoline prices. This is expected to increase headline inflation in the near term. To capture the center of gravity in inflation, we use several measures to look deeper than this headline and assess the underlying trend in inflation. So let me explain the inflation measures we're looking at and why. First, we track measures of core inflation, which exclude large price changes, whether they're up or down, that can obscure the underlying trend in inflation. Core inflation is running around 3.5%. This is true of year-over-year rates, as well as more timely three-month rates. And what that suggests is that inflationary pressures remain and downward momentum has slowed. We also carefully examine the distribution of annual price changes across CPI components. And as you can see in the top panel of this chart, while some prices are always going to be going up and others are always going to be going down, in normal times, price changes tend to be clustered around the 2% target. When inflation went up last year, which is shown in the middle panel, the distribution of price changes shifted to the right. The average price increase was higher, and the range of price changes widened. And you can see in the distribution, particularly on the right side, which means some prices went up very sharply. This points out one of the unpleasant consequences of inflation. High inflation also brings bigger swings in prices. Since inflation peaked in June 2022, the distribution of price changes has started to normalize. But the average price increase and the variability of price changes are both still higher than normal, and you can see that in the bottom panel. Another way to gauge inflation price pressures is to look at whether price increases in the CPI reflect a few big increases or a lot of small ones. And remember that inflation is a generalized increase in prices. To measure the breadth of price increases, we track the share of CPI components whose prices are rising faster than normal. When inflation is close to target, about 30% of the components typically rise faster than 3%. When inflation rose last year, the share of components rising faster than 3% peaked at almost 80%. That's the red line. Today, that's come down to about 60%. The blue line is the share that's rising at faster than 5%. So what you can see from this chart is, yeah, we've made progress, but larger than normal price increases are still broad-based. This highlights another problem with high inflation. No matter how carefully you shop, you can't avoid it. Prices for almost everything are going up, and that includes many necessities. For example, rent was up 5% in July. Home insurance and cleaning products were both up around 9%. Price increases for food average around 9%, and many are in double digits. Bakery and cereal products up 12%, baby food up 11%. Now, the single price increase that is having the biggest impact on CPI inflation is mortgage interest cost. That's gone up as we've increased interest rates. And it's up about 30% relative to where it was a year ago. When you exclude mortgage interest costs from the CPI, what's left is increasing at around 2.5%. And that has led some to argue that inflation is effectively back at target. Now, look, it's true that if we hadn't raised interest rates, mortgage costs would likely be lower today. But inflation throughout the economy would be higher. Inflation would be a much bigger problem than it is today. To measure underlying inflation, we need a more systematic way of excluding components with big movements on both the upside and the downside. Of course, if you take out things that are, if you only take out things that are going up, the measure of inflation you have, of course, looks lower. But that's why we use these core measures to provide a more systematic way. And if you look at CPI trim, for instance, it's excluded mortgage interest costs in each of the last 14 months. Nevertheless, it's still running at about 3.5% because it's also excluded things where the prices have fallen sharply. So the message here is that The underlying trend shows inflation is still well above target. And the longer the underlying trends remains too high, the harder it's going to be to bring inflation down. Now, why is that? Well, it's because households and businesses expect, once they start to expect inflation to be higher, their behavior starts to change. And when that happens, it becomes more difficult to bring inflation back to the 2% target. Looking forward, what do we want to see? We want to see less generalized price increases as well as a decline in the average price increase. Both these things are happening. That is encouraging. But they need to keep happening to restore price stability for Canadians. That brings me to the other factor we're watching closely, the balance between demand and supply in the economy. Inflation has come down from 8% because supply chains have opened up, energy prices have come down, and big price increases of a year ago have dropped out of the data. For inflation to continue to decline, we need the demand in the economy to continue to grow more slowly than supply for a period of time. That will relieve price pressures, slow increases in labor costs, and restore normal price-setting behavior. That's what will bring inflation sustainably back to the 2% target. But I want to be clear. We're not trying to kill growth. We want strong, sustainable growth and a healthy labor market. The best contribution we can make to these objectives is to deliver low, stable, and predictable inflation. Price stability is a cornerstone of a market-based economy. Nothing works well without it. The way we achieve price stability is by using our policy interest rate to find a balance between demand and supply in the economy. Too much demand, inflation rises above the target. Too little, inflation falls below the target. We've seen both in the last 3 years. At the beginning of the pandemic, demand collapsed and inflation fell below 1%. In fact, it even fell briefly negative. We used all of our tools at our disposal to support the economy so that Canadians could continue to pay their bills, businesses could stay afloat, and people would have jobs to come back to when the shutdowns ended. As economies around the world reopened, supply chains became tangled, the demand for goods came roaring back. Businesses couldn't keep up, prices rose quickly, and inflation became a big problem. This shift into excess demand required the opposite policy reaction, and we raised our policy interest rate forcefully to dampen growth, give supply a chance to catch up, and relieve price pressures. So how well is it working? The output gap provides the broadest measure of that balance between demand and supply in the economy. And by our estimates, excess demand peaked in the first half of last year. That's when the economy was the most overheated. Since then, excess demand has eased gradually. Last week, GDP growth for the second quarter was essentially zero. This should reduce price pressures, leading to lower inflation. The weakness in second quarter GDP largely reflected a broad-based slowing in consumer spending and a decline in housing activity. The softening in household spending on goods was most pronounced on larger items that people often buy on credit, like furniture. Together with the decline in housing activity, this points to the moderating effect of higher interest rates are having on household spending. Consumption of services also slowed, which may indicate the effects of tighter monetary policy are broadening from goods to services. It is true that the weakness in overall economic growth was magnified by a few unexpected events, and the most notable of these are the devastating wildfires that we've experienced across the country that are destroying homes, evacuating cities, and weighing on economic activity across a number of sectors. Alberta has been hard hit, and this has disrupted oil and gas production in particular. The labor market is also an important indicator of this balance between demand and supply in the economy. We're seeing signs that the labor market is cooling from overheated levels earlier in the year. This is allowing labor supply to begin to catch up with demand. Employment was roughly flat in July, marking the 5th time in the last 6 months that job growth has been below the pace implied by population growth. So far, we've been able to cool demand without unemployment spiking. As I outlined last November, the fact that job vacancies were at a record high meant we had scope to cool the demand in the labor market without causing a large surge in unemployment. Nearly a year later, what we can see is that job vacancies have indeed fallen significantly, with only a relatively small increase in the unemployment rate. Wage growth, in contrast, has yet to show clear signs of moderation, with most measures running around 4 to 5%. As the labor market continues to come into better balance, we do expect wage growth to slow, and that's something we're going to be watching closely for evidence that confirms this rebalancing in the labor market. Another indicator of the imbalance remaining between demand and supply in the economy, and thus of underlying inflationary pressures, is corporate pricing behavior. As the economy reopened from the pandemic restrictions and many costs rose quickly, companies protected their profit margins by passing on all their cost increases along to customers. They did this by increasing their prices more often and by more. As inflation comes down, businesses are telling us that their price-setting behavior is beginning to normalize. Businesses increasingly expect the size and pace of price changes to decline. But corporate pricing behavior is not yet back to normal, and it appears to be changing only slowly. As long as demand is running ahead of supply in the economy, it's too easy for businesses to raise their prices. We will be watching corporate pricing behavior carefully to be assured that the economy is clearly on the path to price stability. So that's what we've seen in recent months, and that's what we're going to be watching closely. In October, we will publish a new economic outlook. We're going to be looking for continued progress toward this economic rebalancing we need to relieve price pressures, and more evidence that this is translating into lower underlying inflation. So that brings me to a question we have been getting increasingly from Canadians. If it's going to be difficult to get inflation to our 2% inflation target, and we'll be closer to 3% for some time, why don't we just raise the target to 3%? Besides, you have a control range of 1 to 3%. Isn't 3% close enough? Now, we understand why people are asking this question. Higher interest rates are painful, but getting to 2% inflation is worth it. And I want to be clear, we are committed to the 2% target. There are good reasons. First, you don't raise the target just because you missed it. We've been targeting 2% inflation since 1995, and the inflation target anchors our economic and financial system. If you get rid of the anchor or move it when the going gets tough, inflation gets less predictable and more volatile. Nobody wants that. Second, the 2% inflation target has delivered low, stable inflation and lower unemployment rates on average for the last 25 years in Canada. Most central banks around the world have a 2% target because at 2%, inflation is low enough that people don't need to worry about changes in their cost of living one year to the next. Third, the target is not 1 to 3%. The target is the 2% midpoint of the 1 to 3% range. Between 1995 and 2019, inflation was in the 1 to 3% range 80% of the time. But if you want to be in the range most of the time, you have to aim for the middle. If we decided 3% was good enough, inflation would be above the range a lot of the time. The bottom line is 2% inflation is eminently achievable and has served Canadians well. Simply put, when inflation is stable around the 2% target, it removes the anxiety created by large swings in the cost of living. Price stability means households and businesses can plan and invest with confidence that their money will hold its value. I want to make one final point. We review our monetary policy framework, including our target, every 5 years, so that we can be confident it remains fit for purpose. Looking ahead, And I will stress this is a strength of our framework. When you look ahead, Canadian businesses, households, governments, they're all going to need to confront some big global forces. These include demographic changes, increasing geopolitical tensions, climate change, digitalization. And some of these forces are likely to add cost pressures and increase the volatility in prices. And that's led some commentators to suggest that this means we should target a higher rate of inflation. Now, understanding these forces and what they mean for monetary policy is at the very heart of delivering on our mandate. But it's not obvious that allowing for higher inflation is going to help us deal with these challenges. To the contrary, more inflation and the uncertainties that come with more volatility in inflation are more likely to make the needed adjustments that much more difficult. These aren't the first structural changes to confront the Canadian economy, and for the past 30 years, the 2% target has been a helpful anchor as businesses, households, and governments face shifting economic forces. As with past reviews, we will work hard to analyze how the framework's been working, and that includes the 2% target, and whether it's the best framework for the future. You'll probably be relieved it's time for me to conclude. We've come a long way in the past year. Monetary policy is working, and inflation is coming down. But we still have some way to go to restore price stability. With past interest rate increases still working their way through the economy, monetary policy may be sufficiently restrictive to restore price stability. However, the Governing Council is concerned about the persistence of underlying inflation. Inflation is still too high, and there is little downward momentum in underlying inflation. La Banque va évaluer de près l'équilibre entre l'offre et la demande et aussi l'inflation fondamentale pour mesurer nos progrès vers la stabilité des prix. La Banque est prête à en faire plus si on doit augmenter les taux d'intérêt pour rétablir la stabilité des prix. Mais la Banque ne veut pas augmenter son taux de directeur si ce n'est pas nécessaire. La Banque sait que les taux d'intérêt plus élevés causent beaucoup de difficultés à une partie des Canadiennes et Canadiens. C'est pourquoi elle ne va pas ajouter à ces difficultés. Mais il sera plus grave de laisser trop d'inflation continuer. On sait qu'une cible de 2% est la bonne. Cette cible est proche. On doit garder le cap. We will be carefully assessing the balance between demand and supply and underlying inflation to gauge progress towards price stability. If we need to raise interest rates further to restore price stability, we are prepared to take further action. But we don't want to raise our policy rate more than we have to. We know higher interest rates are hitting some Canadians hard, and we don't want to make this more difficult than necessary. But letting too high inflation persist would be worse. We are confident that the 2% target is the right target. The target's now in sight. We need to stay the course. Thank you very much. And I look forward to your questions.
This is the fun part.
Absolutely.
For me, maybe not for you, no. Please make sure you do text on the table on your card if you'd like a question asked to the governor. So we're not done yet. You don't think we're done yet? Raising rates. It's pretty interesting.
Well, I think the answer is we'll see. We're gonna take it one meeting at a time. As I just indicated, it may be the case that monetary policy is sufficiently restrictive to restore price stability. The economy has entered a period of slower growth. That is relieving price pressures. That's an important reason why we kept our policy rate at 5% yesterday. We know there's lags in the effects of monetary policy. But as I underlined, inflation is still too high. The downward momentum has slowed, and we are concerned that there's a certain stubbornness in the stickiness of inflation. So maybe we don't need to do more, but maybe we do. And what I really tried to outline in my remarks were a number of the things we're looking at to gauge that progress.
So when you look at some of the news that's coming out of countries like China, and now there's some concern about the United States from an economic standpoint, how could an economic slowdown in China and potentially south of the border affect your outlook and your decisions going forward? Could that have enough of a moderating effect?
It certainly could. We are, exports are a big part of our economy. I don't need to tell you that here in Alberta.
We'd like to export more, but that's another conversation.
The price of energy, price of oil is very sensitive to global demand. So yes, I think if you were to see a sharper slowing globally, there is no doubt that would impact Canada. We have a global outlook. Global growth has slowed this year. The U.S. economy is also adjusting. Inflation is also coming down in the U.S. As we highlighted yesterday, the U.S. consumer spending has proven pretty resilient. I'll let the Fed speak for themselves, but I think they're asking themselves the same kind of questions we're asking ourselves. But yes, I think if the global economy slows more sharply, that will definitely have an impact on our economy, and that's something we'll need to take into account as we take those policy decisions.
So one of the things you did talk about towards the end of your speech was about volatility, and you just talked about energy. So just how can the bank be sure it doesn't underestimate the impact and the volatility of commodity prices again, as it did, and you acknowledged that in 2021 and 2022?
Look, the Bank of Canada can't control global commodity prices. So that's why we're focused on a broader range of indicators. In particular, our measures of core inflation provide a good indication that strip out the volatile components. Energy is often in that bucket. Commodity prices more generally are often in that bucket. And by stripping out these volatile components, you can see more clearly where the trend is. And I think an important message is that fundamentally, it's that balance between demand and supply that's going to determine inflation. We've had a period where demand has rocketed up as we came out of the pandemic. Business couldn't keep up. The economy became quite overheated, and that's how you get to 8% inflation. Yes, it was juiced. It was it was pushed up even further by the war in Ukraine, by large increases in global commodity prices, by very tangled supply chains. Those global energy prices have come down quite a bit. Recently they've ticked back. Supply chains are certainly working much better globally. So those things have got better. What we're increasingly going forward, we're focused on this balance domestically between demand and supply. There are going to be fluctuations in inflation. As I mentioned, oil prices have gone up recently, so I think you can expect headline inflation is going to go up in the near term before it eases. We'd get nervous if that starts to feed through to our measures of core, but if the underlying track is moving in the right direction, that's what we'll be looking for.
Well, I mean, Saudi Arabia and Russia both announced that they were going to keep production cuts in place until the end of the year, and so that sort of portends that, as you said, oil prices are over $90, so that's going to cause you a bit of a headache, I suspect.
I mean, obviously, if oil prices go up, that's going to impact Canadians. That's going to show up in headline inflation, and that is something we're going to have to evaluate. As I said, we have no control over global oil prices. What we're really going to be looking for is the underlying trend in inflation.
And there's been a number of questions, no surprise, that have come in. So how does the bank plan to manage Canada's growing debt burden what measures will be taken to ensure long-term fiscal sustainability. And I guess the other sort of just to add to that, debt's at about $2.3 billion from a consumer standpoint. So just wondering how you're looking at all that.
Well, the short answer is the Bank of Canada is not going to manage that. That is the job of our elected governments to manage that. Fiscal decisions, governments have many priorities. They have a tough, it's a tough job balancing them. That is appropriately decisions of our elected governments. Our mandate is control inflation. So what do? Is we take the government's fiscal spending, taxing decisions, and their fiscal plans, we take those as given, and we build those into our outlook. And then we take the actions that we judge are necessary to deliver on our mandate for Canadians. I think that's what Canadians expect from us.
The $2.3 billion in consumer debt, does that worry you at all from an economic standpoint?
The Canadians, the indebtedness of Canadians has been trending up for some time. That does create a vulnerability. As long as you can sustain that, that's fine. But certainly, if we were to get into a serious downturn, it's not what we're projecting. We're projecting slow growth, but it's positive. We're not projecting a serious downturn. But if you did get into a serious downturn, and you do, large numbers of people lose their jobs, that's when that vulnerability could really come home to roost, and it could make a difficult cycle that much worse, and certainly for many of those individuals, very tough. As I say, that's not what we're projecting. I don't want to minimize the pain. It's not going to be easy, even with slow growth, but we're not projecting a big surge in unemployment.
You briefly mentioned the slowdown in consumer spending during the second quarter. Is it a soft patch, or is it really a signal that the economy is slowing down?
I think you have to, one quarter to the next, there's always going to be some ups and downs. But if you look over the last 3 quarters now, Q4 last year was 0, Q1 was 2.6, this quarter was minus 0.2 annualized. When you average those, what you've got is something a little less than 1. Yeah. And we'll put out a new forecast late October, but we're expecting growth in that range, somewhere a little less than 1 for next few quarters. So that's slow growth, it's positive growth. If you're forecasting a small positive, you can't rule out that you get a couple small negatives. But that's not what most people think of when you talk about a recession. In our view, that's what's, we need this period of slower growth to relieve those price pressures, to restore price stability. And then when we get there, growth can pick back up, the economy can grow again, inflation, interest rates can come down, and we will have low, stable inflation.
Might be a bit of a tricky question. How is Canada's fiscal policy impacting the Bank of Canada's ability to achieve its mandate? You are independent, and that was made pretty clear when Minister Freeland said what she did yesterday.
Well, I think I've already addressed how fiscal policy fits into the decisions we take. We take it as given, and then we do what we need to do. We do what Canadians have charged us to do. How is fiscal policy affect us? So if you look over the last several quarters, the government spending, and when I say government spending, that's all levels of government, federal, provincial, has been running at about 2%. So it's contributing to growth. It's contributing to the growth of demand in the economy. And in that sense, it's not helping to slow the economy. It's not helping to relieve those inflationary pressures. But as I said, we take those fiscal plans, we put them in our models, we come to a judgment about the path forward for the economy. And in our forecast we put out in July, we have inflation coming gradually back to our 2% target around the middle of 2025. So we're getting there. I think the last thing I think I would say about government spending is that if governments were to increase their rate of growth of spending considerably, that would add more to demand, and that would make it harder to get inflation back to the 2% target.
Question, how do the annual increases in carbon pricing impact inflation, and does it impact your decisions differently than any other forms of taxation?
So, as you're well aware, the carbon tax goes up periodically. So when we forecast inflation, we know what the carbon tax is going to do. So we build that into our forecast just the way we build in other elements, other fiscal decisions. The contribution that's making to inflation one year to the next is relatively small. If you want me to put a number on it, it's in the range of 0.15%. Okay. So, quite small. But yes, that is something that we factor in to our forecast, and it's built into the forecast I just gave you.
So one of the, we sit here in Alberta, and you have to look at the entire country. When you assess the health of the economy, are there provinces or sectors that you're more concerned about? I mean, it's tough to set policy that fits and addresses the different makeup of every province and region across the country. So I'm just, how do you factor all that in to make sure you do the right thing?
Well, two comments there. I mean, first of all, we have a vast country. That's a great asset for Canada. And look, we always have some parts of the economy growing faster and other parts growing slowly, and those tend to change over time. If you look at inflation across all the provinces over time, what you see is, it can be a bit different one province to the next at any one point in time, but on average over time, provinces all converge to roughly the same inflation rate. So if you're hitting 2% inflation on average nationally, on average you're going to be hitting 2% inflation in the provinces as well. The second thing I'd say is that if you look across the country, yes, conditions can be a little bit different one province to the next. The industrial structure of our different provinces is different. But I think one of the things you've really seen through COVID and through the recovery is that actually it's been very correlated. We all had shutdowns. We all had a very serious recession. We've all experienced a really rapid recovery. The manufacturing sector was booming when we all wanted to buy goods. Increasingly, as things have reopened, we all want services. That's supporting the service sector. And then global demand for our natural resources has been very high. So really, all parts of the economy have been very strong. And that's when everything's overheated, that's how you get to 8% inflation.
Right. One of the things we talk about a lot is our lack of productivity, economic output per capita. And we rank at the bottom on a per capita basis in terms of output per GDP per capita. So how does the bank view the role of technological advancements to boost productivity? And what do we need to do in order to close that gap?
How long have we got, Deborah?
As long as you like.
Well, let me start with on a brighter spot, and then I'll come back to productivity. Okay. I mean, what are our big strengths? I think it starts with people. We're very good at growing our economy by adding people. We have a very well-educated workforce. We have high rates of labor force participation in this country. If you look at female participation in Canada, it's well above what it is in the United States. We are an attractive place for immigrants globally. We do a good job of integrating newcomers to Canada into our economy. And for all those reasons, businesses have been very effective in growing the economy by adding workers. We have a wonderfully diversified economy, abundant natural resources, vibrant manufacturing sector, big service sector. You've got all of those in Alberta, and that's a big asset. Our Achilles heel is productivity. We're really good at growing by adding workers. We're not very good at increasing the output per worker or productivity. And why that is a massive topic, and there have been more studies than I can name over, and it's not a new issue. It has been a long-standing Canadian issue. I guess what I'd say is that, look, there are some structural issues in the Canadian economy that aren't going to get changed anytime soon. We're a vast country. We have large, big transportation costs. We've got a lot of small and medium-sized businesses. We know small and medium-sized businesses don't have as many resources to invest in new technologies. They don't tend to be as productive as bigger companies. We also know, if we look at the productivity data, that export-oriented companies tend to be more productive than internally oriented companies. Well, that probably suggests competition is a factor.
Or the internal trade barriers.
Or internal trade barriers.
Yeah.
Yes. So, these are some structural things. We need to work on those, but, we're not going to change those things overnight. I think where we could change things a little quicker, and I am speaking to a business audience, what we saw through the pandemic is just how resilient, how dynamic, how innovative the business sector can be. I mean, you figured out how to serve your customers digitally when you couldn't serve them in customer. You figured out many of you figured out how to get large parts of your workforce working off-site at home. You invested, even in the depths of a serious recession, you were investing in new digital technologies to make those things happen. And I think we need to take that spirit, because one of the things we see is that investment in the business sector, in new machinery and equipment, new information technology in Canada is not as strong as in our competitors. You're running businesses, you know your businesses much better than I do. You also know your competitors aren't standing still.
Right.
And that productivity growth, that's what sustains our competitiveness globally. That's what pays for rising real wages. And fundamentally, that's what creates rising per capita standard of living.
And yeah, it offsets the demographic curve as well, right?
Yes.
Last April, you released your first report on climate risks and the effect it could have on the Bank of Canada's mandate. And the Australian Central Bank also weighed in recently, saying climate change was going to result in greater volatility and inflation, making the setting of monetary policy even more challenging. How are you looking at climate change affecting monetary policy?
Well, the first thing I want to underline is that Bank of Canada does not set climate policy. Climate policy, like fiscal policy, is set by our elected governments, and that's appropriate. We don't have a direct mandate for climate change. Our mandate is to control inflation. But climate change is a major force. I don't need to tell you, you're running businesses, you're seeing the impact on your businesses. Yeah. It's a major force affecting the economy. We're seeing it already. It's creating more volatility, more forest fires, more floods. Not every forest fire, not every flood is caused by climate change, but the trend is that they're going up, and that is caused by climate change. There's also, we're in the beginnings of a large transition to cleaner growth. That's going to impact the Canadian economy. So, we need to understand that to do our job. We need to understand what are going to be the impacts of climate change on the economy. How is that going to affect inflation? Another one of our mandates is we promote a stable financial system. There are, if climate risks are not appropriately priced, there's a risk that when they crystallize, you see a very rapid repricing, and that could threaten financial stability. So we have been working with our prudential regulator in Canada, the Office of the Superintendent of Financial Institutions, together with a large number of financial institutions, to help them better assess the climate risks that they have on their balance sheet, so that we get a smoother transition and we don't get big bumps.
So, I just sort of referenced the comments by the Australian Central Bank. Just, on a broader scale, how often do you, talk to other central banks? We live in a global economy. Is there some coordination of policy direction, or is it how do you factor in what everybody else is doing when you're setting interest rate policy?
Well, one of the nice things about being in the central bank business is you're not competing with your the other central banks. You're all kind of in this together.
Yeah.
So we do share a lot of information. In fact, this weekend I'm heading to Switzerland, where the governors are meeting. The governors of the major central banks will be meeting over the weekend to share perspectives. I mean, first and foremost on the economy, on how the path back to price stability is going. But we also do share information and analysis, and we even sometimes work together on global issues, and certainly climate change would be one of those.
Right. Just a hypothetical question, perhaps. If we didn't have to deal with the conflict in Ukraine, how much would we be still dealing with an inflationary environment because of the knock-on effects of what's happened from a supply chain, from an energy standpoint, from a agriculture standpoint as well? Or is that just
well, look, there's no question Russia's unprovoked attack of Ukraine has created a lot of global uncertainty. It has certainly impacted particularly global commodity prices, not just oil, but wheat, potash. If it'd be wonderful if the war was resolved for so many reasons. Economically, that would certainly be a very positive thing, but it wouldn't alleviate the excess demand in the economy. I mean, you're running businesses. I'm sure certainly what we're hearing from businesses is it's been hard to find all the workers you need. Yeah. We hear it is getting easier. You're catching up, but it's still tight. That rebalancing, if we want to get inflation down, that rebalancing needs to continue.
So one of the questions that's just come in is is there any other lever that you can use to address inflation, or is it's monetary policy and that's it?
Well, certainly the lever we have, our primary instrument is our policy interest rate. And yes, when the economy's overheated, when inflation's too high, we raise that. We've raised it very forcefully. It's working. We're not there yet, but we're going to get there.
Question about exogenous variables. Are you worried about an exogenous shock that could cause your plans for hopefully staying put or taking rates down change what your outlook is?
Well, the thing about exogenous shocks, the thing about shocks is, well, you can't forecast them because they're shocks. If they were forecastable, they wouldn't be shocks.
Right.
So yes, you always know that, as you move forward, there are going to be new events. There are going to be unexpected events. And monetary policy works with a lag. We have to try to look forward to where inflation's going to be when we take actions now. And of course, those forecasts can be knocked off when there are unexpected events. So you need to take what we sometimes call a risk management approach. And when inflation is above the target, and it's been above the target for a long time, you are more worried about those upside shocks to inflation than downside.
Yeah.
Because there is a real danger that if Canadian businesses start to believe that inflation is not coming back to the target, well, that's going to make it that much harder to get it back.
Did we get too used to low interest rates as a result of the financial crisis in 2008 and all the quantitative easing? There were times in the past, in the 50s, 60s, mortgage rates were about 6%, and that was considered not bad. Did we just get a little complacent?
Predicting where the sort of trend or neutral interest rate is going to be is difficult. I think when you look forward, I think it's our own models with the data we have say the neutral interest rate. And just to tell you, so the neutral interest rate is like this idea that economists made up, and it is sort of the interest rate, what the interest rate would be if the economy is roughly in balance, inflation's on target, and there's no big shocks.
Right. Goldilocks.
Goldilocks,
Goldilocks,
exactly.
yeah.
So, and we think that the neutral interest rate is somewhere between 2 and 3%. That's based on historical data. If you look forward, I think it's fair to say, when you look at some of the pressures which I mentioned, climate change, aging demographics, rising geopolitical tensions, the need to make supply chains more resilient, those things, and also higher levels of government debt globally, so demand for more need to sell more debt. Those things could all be pushing the neutral rate up a bit. So when you look forward, although the data we have right now doesn't make a compelling case that it's changed, it seems more likely that it's going to be above historical estimates than low. So what does all that mean? Look, as we get back, as there's clear evidence that we're really getting back to price stability, yes, interest rates should come down. We're not there yet. It's too early to be thinking about interest rate cuts because we're not there yet. But we will get there.
Okay.
But I think you're running businesses. I don't think you should expect they go back to where they were in the decade between the global financial crisis and COVID. They could well settle at something higher than what we saw in the previous decade.
So a new normal.
A new normal.
Last question. What's the one takeaway you want to leave with the room today?
The one takeaway I want to leave with the room is that inflation has come down a lot, from 8 to around 3. The progress has slowed. The decisions are getting difficult. We know Canadians are feeling the pain of higher interest rates, but the target's in sight, the destination is worth it, and we need to stay the course.
And hopefully you don't get any more letters from premiers.
Just saying.
Well, I really appreciate
Good afternoon. My name is Amélie Ferron-Craig, Press Officer at the Bank of Canada, and I will be moderating this press conference. Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will be bringing to you if you raise your hand. And we have a lot of people in the room today, and we also have a lot of journalists participating by teleconference. So we'll do one question in the room, and then we'll turn to the call to try to make sure that everyone gets a question. And the governor will be happy to answer questions in both official languages. Alors, on va commencer par les journalistes qui sont dans la salle aujourd'hui, avant de passer aux journalistes qui participent par téléconférence. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. So we'll start taking questions.
Hi, my name is Robert Tuttle from Bloomberg News. My question is, given your institution's relationship with Canada's finance minister, is it appropriate for Freeland to be characterizing your decision to hold rates steady on Wednesday as a, quote, welcome relief?
Look, the Deputy Prime Minister and other elected officials around the country, they're hearing from their constituents. And I think, they're hearing what we're hearing. We're hearing directly from Canadians that high inflation is hurting them. And they're hearing that the increases in our policy rates certainly squeezing some Canadians and making life even more difficult. I think you've seen elected officials around the country express that. Look, unfortunately, there is no pain-free way to restore price stability. The destination is worth it. We don't want to make it any more difficult than it has to be. But we do require higher interest rates to lower inflation. If we hadn't raised interest rates, inflation would be a much bigger problem. Monetary policy is working. As I highlighted in my remarks, we're not there yet, but the target's in sight. We need to stay the course. The Bank of Canada is set up to be operationally independent. There are good reasons for that. And that operational independence, that independence, it's more important when the decisions are difficult. The decisions are difficult. I am confident that the Bank of Canada remains independent. We have a clear mandate. Canadians expect us to control inflation, and that's what we're doing.
Hi, Sean Polzer, Western Standard. In your remarks in the room, you said the impact of the carbon tax was about, 0.15% on inflation. I'm just wondering how you arrive at that number and whether that gets factored in through not just energy costs, but all the inputs, because obviously there's a lot of inputs in agriculture and in manufacturing.
Yeah. It's a good question, and we can take this offline if you want. But yes, that is the direct impact on the components that are most directly affected. It does not include any second round effects.
And is the economy going to absorb it, given that the carbon tax is going to essentially triple between now and 2030?
So the carbon tax, the announcements have it going up. As I said, our estimate is that increases inflation each year by 1.15%. So inflation's measured over 12 months. So yes, each year it's 0.15, but that's a relatively small effect on year-over-year inflation.
Anis Hidari, CBC. You have mentioned that so far you've been able to cool demand. We've been able to cool demand in the economy without unemployment spiking. We've got jobs numbers coming out tomorrow. Are you expecting that to continue? What are you hoping to see out of the jobs numbers tomorrow?
Well, look, I'm not gonna hazard a forecast on the job number tomorrow, but I will say what we're expecting to see. We have what have we seen? We have seen a gradual easing in the labor market. And you can see that in a number of statistics. The vacancy rate has come down. It's taken some time, but it's now come down quite a bit. The employment growth has still been certainly positive. Employment's still been growing, but it's been growing less than population growth. So what that suggests is that the sort of supply of workers is growing more than the demand for workers. So supply is catching up with demand, and those pressures are easing. So we expect to see continuation of that trend. We expect to see, for a period, employment growth continue below population growth. Certainly we've seen easing in the labor market, but there are still labor shortages. Labor market is still somewhat tight.
Dylan Short with allsaskatchewan.com. In the past, we've seen when there's been pauses that there's been, mini housing booms. Is that something that you're worried about this month, or is that something that was taken into consideration, what's happened after previous pauses?
Look, the housing market is an important part of the economy. We have one instrument, our policy interest rate, and we have one objective, and that's price stability. and we have to look at the whole economy. So what's going on in the housing sector certainly factors in to our decisions, but it factors in along with a lot of other things. What have we seen in the housing market over the last number of years? When interest rates were at emergency low levels, housing prices, demand for housing soared. Housing prices went up very sharply. They were up on a national basis about 50% over 2 years. With the forceful increase in our policy rate, housing prices actually came down 15–16%. They've since bounced back up a little bit, have been relatively stable. At the same, so that if that was the only thing that happened, that would have improved housing affordability. But of course, higher mortgage costs higher interest rates make the carrying costs of mortgages higher. So that's hurting housing affordability. But I guess what I'd say is, look, we had housing affordability issues when interest rates were very low. We've now raised interest rates. We still have serious housing affordability issues. I don't think you're going to solve this problem with interest rates. The fundamental issue is, for a number of years, demand for housing has been running ahead of supply. And the one thing I will say, housing policy is policy of elected governments, not the Bank of Canada. But we are pleased to see that governments at all levels are really starting to get together, to put their heads together and figure out how are we going to cut through some of the barriers to growing supply.
Hi, Jason Markisoff from CBC Calgary. I want to thank you for the 0.15% figure. It's not something I'd heard, and it definitely contributes to public discourse on this. Is there a comparable figure for the impact on inflation of government's spending?
So, that's government spending, of course, covers all sorts of things. And government spend, you have to look at, some parts of government spending largely affect demand. And obviously, everything else equal, that contributes to inflationary pressures. Other parts of government spending have important effects on supply. So, for example, subsidized daycare increases labor market participation, particularly of women with young children. That adds to supply in the labor force. On the other hand, other policies add to demand. So I can't give you a nice number because government spending is not one policy. It's many, many policies. What I can say is that if you look at overall government spending in the economy over the last number of quarters, it's been averaging around 2%. So government spending, and that's all levels of government, federal, provincial. What that means is that government spending is contributing to growth. It is adding to demand in the economy. We take the government's plans into consideration. They are built into our forecast. We take the government's budgets, their fiscal plans, we build those into our projection. And in the projection we published in July, we have inflation coming gradually back to our 2% target by 2025. Now, if governments were to increase the rate of growth of spending, that would make it more difficult to get inflation back to target.
Bonjour, Nassim Aoué à Radio-Canada. J'ai une question par rapport à l'impact de l'augmentation du taux directeur sur les Albertains, surtout que la majorité de leur endettement ici dans la province, c'est un endettement de carte de crédit où c'est un taux fixe, alors que le prêt hypothécaire touche le reste du pays. Est-ce qu'il y a une différence? Est-ce que vous pouvez expliquer ce qui se passe en Alberta, l'impact de ce taux en Alberta, considérant que c'est surtout un endettement de carte de crédit à taux fixe?
Il y a toujours des différences entre des différentes provinces. Les marchés de logement, par exemple, peuvent être dans une situation un peu différente, une ville à l'autre. L'endettement des citoyens peut être un peu différent. Mais Alberta regarde similaire à la plupart du pays. On voit demande pour logement est très fort ici. C'était un peu moins fort ici que d'autres provinces, comme surtout les grandes villes, Montréal, Toronto, Vancouver. Calgary était un peu moins, les hausses les prix de maisons étaient un peu moins ici, mais maintenant on commence à voir plus de demandes ici. Si on regarde des autres aspects, ils sont similaires. On sait que l'endettement des Canadiens est plus élevé et ça suggère que si c'était la seule chose, que les effets de l'augmentation de notre directeur sera plus fort parce qu'ils ont plus de dettes pour payer l'intérêt. Mais à l'autre côté, ici à Alberta, comme le reste du Canada, l'épargne pendant la pandémie était plus haut parce qu'on ne peut pas aller au restaurant, on ne peut pas aller en vacances. Et donc, les dépôts dans les banques sont plus élevés. Et probablement, donc, les deux effets contrebalancent d'un certain extent. Donc, est-ce que l'effet du politique monétaire est plus fort ou plus faible? À ce point-ci, c'est difficile à dire, mais c'est à peu près le moyen d'histoire. Okay, let's see if I can remember it all. So the question was about are there particular differences in the indebtedness of Albertans or the financial health of Albertans relative that are different from the rest of the country? And I mean, the short version of the answer is, look, there are always some differences between provinces. Certainly, housing markets tend to be somewhat local. The Calgary market you did not see house prices go up as much in Alberta, certainly big cities in Alberta, Calgary, Edmonton, as you did in Montreal, Toronto, Vancouver, for example. However, you're starting to see those things are starting to equalize. You're seeing more strength here in housing. So, the basic message is Alberta looks pretty similar to the rest of the country. And the other thing I mentioned is that, for a number of years now, household indebtedness has been rising in Canada. Other things equal, you would expect that higher interest rates would have more traction if households are more indebted because they've got to pay more interest. However, on the other side of that, households built up what economists at least call excess savings during the pandemic. Basically forced savings. We couldn't take a vacation. We couldn't go to a restaurant, so we spent less money, and so households have extra deposits, more deposits than usual in their bank accounts. That may be buffering that. So the lags of the effects of monetary policy, I mean, we'll have to see in the fullness of time. But so far they look about normal, look about average of history.
Hi there, Jordan Canagan with CTV News. Thanks for taking my question. Some economists have suggested that Canada is in a recession or is on the verge of heading into one. Do you agree with that assessment, and why or why not?
I don't think we're in a recession. You look at the unemployment rate; it's 5.5% unemployment. The labor market remains healthy by sort of any normal measure of GDP growth. I mean, GDP growth was very slightly negative in the second quarter, minus 0.2 annualized, essentially zero. What are we? I think what they're referring to is more about where we're headed, and of course, nobody can know the future for certain. What are we expecting? We are expecting low positive growth. So, you take the average of the last 3 quarters, growth's been a little less than 1%, and we'll put out a new forecast in late October, but, I expect the recent trend, it'll be something around the recent trend for the next few quarters before it picks up once again. Is that a recession? No, that's not a recession. But I will say that if you're forecasting very small positives, you can't rule out that you could get a couple of small negatives. Some people might call that a technical recession. I don't think, a couple of very small negatives are what most people think of when they think of a recession. It's not a big contraction in output. It's not a large rise in unemployment.
Thank you. So we will now be going to questions on the phone line. I would just like to remind people on the call to mute their line if they're not asking a question. So we will start by Najoud Al-Maliz of Canadian Press, then we'll go over to Paul Vieira of Wall Street Journal and Steve Shearer of Reuters. So you can go ahead, Najoud.
Hi, Governor. Given recent remarks by Minister Freeland and the suggestion from the NDP that the minister could ask the Bank of Canada to stop raising interest rates, I want to clarify what's at stake here. If the finance minister issued a directive regarding rates, would you decide to carry it out or resign?
Look, I think this is a pretty hypothetical scenario. I think the Deputy Prime Minister has been very clear that she fully respects the independence of the Bank of Canada.
Thank you. We will now go to Paul Vieira of Wall Street Journal.
Mr. Macklem, in your remarks, you talked about interest rates might be at sufficiently restrictive levels. Is this a signal that the Bank of Canada is prepared to sit tight and that no further rate increases might be necessary?
Paul, I hope we've been pretty clear. We're going to take this one decision at a time, and we're going to take those decisions based on the best available information and analysis at that time. Yesterday, we kept our policy rate at 5%, and we agreed that we were prepared to raise interest rates further if needed. So your next question is probably, well, what is if needed? I mean, what are we seeing? I mean, what we're seeing is monetary policy is working. Inflation has come down significantly. And the economy has entered a period of weaker growth that's needed to rebalance demand and supply and relieve price pressures. But look, inflation is still too high, and we are conscious that the downward momentum in inflation has slowed. And as we emphasized in our policy statement yesterday, we are concerned about the persistence of inflationary pressures. So we are going to be carefully watching and assessing a variety of inflation indicators. I spent quite a bit of time today outlining some of the most important ones. And look, if we come to the conclusion that we haven't done enough, we're prepared to do more, but we don't want to do more than is necessary.
Thank you. We'll go to Steve Shearer of Reuters.
Governor, Canadian productivity has fallen in 11 out of the last 12 quarters. Has this made it harder for you to bring inflation down? And, in terms of Canada's serious economic problems, would you rank it as one of the top ones?
Short answer is yes. Weak productivity growth has been a serial problem in Canada. And as I just responded to a question a few minutes ago, there are some structural reasons for that. Canada has some structural advantages. It also has some structural disadvantages. We do have some structural disadvantages on the productivity side, but there are certainly things that we could be doing more to improve our productivity. I'll be frank. Coming out of COVID, we thought we would see more of an uptick in productivity. Just the fact that COVID protocols, we didn't have to deal with protocols. Many people are back in the office. We're working in a much more normal format. Supply chain issues have significantly improved so that production isn't being disrupted. So far we have not seen that, and that is a concern. As you mentioned, productivity growth has been declining, and certainly our own forecast is we've seen reasonably good business investment. Our own forecast is that productivity growth will turn around, but that is a risk to the outlook, and if productivity growth continues declining, it will make it more difficult to get inflation back to target.
Thank you. So the next round of questions will go to Mark Rendell of the Globe and Mail, then we'll go to Greg Quinn of Market News, and then Craig Lord of Global. So over to you, Mark.
Thanks for taking the question, Governor. You talked today about how the inflation target is now in sight, and I'm wondering if you can explain what you mean by that, and also how it ties back to the July NPR where you extended the timeline to hit 2% out to 2025. So I guess how would you describe what you mean by the target being in sight and how that fits with the timeline extension that you put in the NPR about a month and a half ago?
Well, I think that there's two parts to that phrase. The target's in sight, but we're not there yet. So the target's in sight. Look, we've come a long way. I mean, last summer we were at 8% inflation. We were increasing interest rates in steps of 100 basis points and 75 basis points. We have come a long way from there. Inflation has come down significantly from 8 to a little over 3%. The economy also, it is rebalancing. You can see the adjustment in the labor market. You can see the impact of higher interest rates on household spending, particularly in the interest-sensitive items. It looks like it's starting to spread to services. So, in that sense, that's what we mean. The target's in sight. We've come a long way. The conditions are in place to bring inflation back to target. Having said that, we're not there yet. Inflation is still too high, and we are concerned that downward momentum is slowing, and those underlying inflationary pressures, they're looking stubbornly persistent. So we think the conditions are in place, but we've still got some ways to go. We've been very clear on the things we're watching. And as I've said a number of times, if we need to do more, we're prepared to do more, but we don't want to do more than necessary.
We'll now go to Greg Quinn of Market News.
Hello. The rate statement Wednesday had several references that could have perhaps fit in with the decision to hike again. Slow progress in getting inflation down, gasoline prices on the rise again, and a risk of an entrenched inflation. Was there much discussion of another hike this week?
Well, you'll receive the summary of deliberations in about 2 weeks, so you'll get a more detailed assessment. I think the clear consensus around the table, I think where members, I think what everybody could see is since mid-July, evidence that the economy was slowing, evidence that demand and supply were coming into better balance, that evidence had become clearer. And as I just mentioned in the response to Mark's question, if you look at the labor market, we continued to see gradual adjustment in the labor market, vacancies coming down, unemployment rate ticking up. Clearly, second quarter GDP growth essentially flat. And you also, look at the components of that. I mean, yes, the weakness in second quarter GDP growth, it was magnified by, well, particularly by the forest fires that have been we've seen across this country. But even controlling for that, consumption weakened quite a bit, and you can see it particularly in the interest-sensitive elements of consumption, which suggests that higher interest rates are having traction, and although we are concerned about the persistence of inflationary pressures, as demand and supply come into better balance, that should relieve price pressures. And I think that was, that was really front and center in our decision, both to keep the policy rate at 5% yesterday and the agreement among the Governing Council that if we needed to do more, we are prepared to raise interest rates further.
Thank you. We'll go to Craig Lord of Global.
Hi. When the Bank of Canada held interest rates earlier this year, there was more explicit language about it being a conditional pause in the tightening cycle. Some economists, in hindsight, maybe said that had an effect of reigniting, some consumer spending and the housing market. Why was there no language about a conditional pause on Wednesday's announcement?
Well, I think the situation today is pretty different than the situation when we announced the conditional pause in January. I mean, you have to keep in mind, when we announced the conditional pause, we just come off a period where we had raised interest rates at the fastest pace in the Bank of Canada's history. As I just mentioned, last summer we were, doing policy increases in steps, 100, 75. We went on to, then it was 50s. So, this was an unprecedentedly rapid pace. And it made sense to pause and allow that to feed through and see what the effects of that were. And we were very clear at the time. Yes, we announced we're on a conditional pause to assess whether monetary policy is sufficiently restrictive to restore price stability. And after 4 or 5 months, with an accumulation of evidence that excess demand was proving more persistent, inflationary pressures were proving more persistent, we came to the view that we hadn't done enough, and obviously we raised rates in June and July. This time, I think the message is we're going to be taking it one decision at a time. Interest rates may be sufficiently restrictive to restore price stability, but given the persistence of underlying inflation, there's a number of things we need to see before we can be more confident in that conclusion. And I think we outlined the things we're particularly watching in the press release.
Okay, we have a quick last round of questions on the phone. So we'll start with Max Sato of Mace News. Then we'll go over to Barbara Schechter of the Financial Post, and then Mary Brooke of Island Social Trends. So Max Sato, you can go ahead.
Thank you, Governor. My question is about how you're going to make sure that inflation is not going to rise again when it has actually come down to around 2%. Do you think your approach has an element of an overshoot commitment to make sure that inflation is not going to come back again? Or would it be risky to change your policy stance after confirming in the lagging indicators such as the CPI?
I had trouble catching all of your question, but I think what you were saying is, are we trying to, how are we balancing those risks? Well, first of all, let me say, our July forecast has inflation staying roughly around 3 for some time before gradually coming down to the 2% target by the middle of 2025. We'll be publishing a revised outlook inflation forecast in October. Since then, as we've highlighted, there's clear evidence that demand and supply are coming into better balance. That should help relieve inflationary pressures. On the other hand, in the short run, we know global oil prices have gone back up. That's undoubtedly going to lead to some increases in gasoline prices. So, for the next at least couple of months, you're probably going to see the headline inflation prints higher. we expect inflation should ease. But look, going forward, as I've underlined a number of times, we're going to be looking for further evidence that inflationary pressures are easing. And I think we've been pretty clear about the indicators we'll be watching to make that assessment.
We'll go to Barbara Schechter of the Financial Post.
Hello. I guess this is a good time in the call to ask about if what you think is going to come to pass comes to pass and you do get to target, what does that mean in terms of rates? Will it be just a steady hold for a while, or will things start to come down? And do you foresee it coming down in small increments like you've been going up recently, or larger chunks if things are under control like you were doing earlier on the raising side?
You know, when the economy is in balance, when inflation is back to 2%, we do expect interest rates can come down. And you know, given that monetary policy needs to be forward-looking, you could well start that before you're all the way there. But we're not there yet. Inflation is still too high. We are concerned about the persistence of underlying inflationary pressures. So it is too early to be talking. It's still much too early to be talking about interest rate cuts. You know, we are really going to be looking for that evidence that inflation is coming down. And as I've said a number of times, if it becomes clear that we're not on the path to price stability, we are prepared to raise interest rates further. We don't want to do more than we have to. We know interest rate increases have hit some Canadians very hard. We know it's squeezing them. We are certainly hearing from Canadians, and we can see it in the data. We can see the impacts in the data. So we don't want to underdo it. We're committed to getting back to our 2% target, but we also don't want to over-tighten.
But as to what you just said about your latest, the 2025 sort of outlook, you're saying that you could start bringing them down before you even hit that 2%?
Look, if the conditions suggest that we don't need as restrictive monetary policy to hit the target, yes, we can lower interest rates. But I do want to underline again that we're not there yet, and it is too early to be talking about interest rate cuts. We are still assessing whether monetary policy is restrictive enough to get us back to the target.
Okay, thank you.
Okay, we're quite over time, so we'll wrap up with Mary Brooke of Island Social Trends. You can go ahead, Mary. Mary, are you on the line?
Yes. Can you hear me now?
We can hear you not very strongly, though.
Oh, okay. You had response to political commentary from the premiers.
We can't really hear you.
Sorry.
Maybe you can send quickly your question in the chat and I can read it out for you.
All right, when you go to our next question and come back.
Okay, we'll go quickly to one. We'll just see if we can hear from Mary quickly. Okay, I think we will stop here, given that we are over time. So thank you, everyone, for participating.
Thanks very much.